think the key question is, we've obviously, as you say, got inflation over target. Nothing like we had a few years ago, let's be clear. We've had a number of sort of individual things that have contributed to it. They're really more to do with what we call administered prices and telling us really about the underlying state of the economy. But all inflation is inflation, so we have to watch very carefully for the consequences of that. Will it lead to sort of, in a sense, persistence or not? Now, our current judgment is, we think probably less likely to do. And why is that? The reason is that I do see some underlying weakening, particularly in the labour market going. I think the labour market is softening. We've had a pretty tight labour market, so it is softening. Although we've got pay increases that are well over a level consistent with target, all the sense I have, and particularly from going around the country, is they are beginning to come down in terms of level of increases, that is. But that's the key judgment. I've said a number of times, and I'll say it again today, I think that the path of interest rates will continue to be gradually downwards. I haven't changed my mind on that. But in terms of, you always ask about the next meeting, where are we going to go in the next meeting? Well, we'll see. But for me, the key question is that softening that we're beginning to see going to come through and, in a sense, create the context where inflation will come back down to target?
Yeah, but also energy prices have been coming down, and the big threat of like an escalation in the Middle East is more or less off the table. So does it give you a bit more visibility that inflation could actually credibly come down?
Well, I mean, obviously that's helpful. I mean, of course, they went up and they came down. And of course, this is the world we're in at the moment. I mean, we have been for a few years now, that we're getting these quite big supply shocks going on. So we had obviously an increase in energy prices. They've now come back down again. Obviously, that's good for all sorts of reasons. So that's a helpful piece of backdrop, as it were, to one of the causes of the increase that we saw in inflation, these administered prices, particularly for household energy prices in the UK. We have a regulator set cap. That cap went up. The path now looks as if it will be easing off. Yes, for the moment. Yes.
Yeah. We also need to talk about the fiscal stance of the government, because clearly it's not a given that the budget planning is intact, I would say, and that they can get around tax hikes during the second half of the year. You've been alluding to that as well, that you think they are too optimistic when it comes to productivity growth. So what is the implication from that for monetary policy?
Well, can I make the point on productivity growth I made is actually more of a long-run point. Actually, when you look at our productivity growth numbers in our forecasts and those for the Office for Budget Responsibility for the next 2 years, we're pretty much the same, actually. So the next 2 years, I was making more of a longer term point that I think that to see a sustained upturn in productivity and therefore supply side growth, which of course we all want to see, will take some quite sort of, in a sense, major change, particularly in the area of innovation, productivity growth. I tend to point to AI, I think, as being what's likely to be over time the next big, in a sense, general purpose productivity growth. I think the difference between us is probably that I think there are other views which says cyclically productivity will come back. I'm not convinced about that, but I am optimistic that I think we are beginning to see sort of what I would call this next big technology change, which should help productivity. So it's more of a longer run point than a point for the next 2 years. On the fiscal position, look, I don't comment on the fiscal position because that's for the government. What I will say is two things. The Chancellor has obviously set out some very clear fiscal framework. That's important. I think it's important that there is a suitable amount of flexibility in that. The other point I'd make is much more, again, a long run point. But it's important to see the sort of, in a sense, the headwinds that all countries are now operating against. One is obviously we've all got pretty much populations that are on average aging and will do going forwards. That has implications for policy. Criticism of anybody, that's a fact, as it were. The second one, obviously, is that what I might call the post-Cold War defence dividend is obviously over and is turning round. So those are headwinds, but I think the UK's got a fiscal framework. Chancellor and I discuss it often. I know the Chancellor is very committed to having a robust fiscal policy in place, and that is important as a backdrop to macroeconomic stability.
But are you not at any point concerned about the development of the yields on your bond markets? Because if you compare them to other countries, big countries, they are among the highest.
Well, I think what we've seen, actually, we've seen pretty common patterns. So our benchmark, short and medium, the short end of the curve has not moved much. Benchmark up to 10 years hasn't moved a great deal. What we've all seen is a steepening of the yield curve thereafter. So the long end of the yield curve is, and that's true for all of us. Now, the UK is a bit different in one important sense, that the UK over the years has issued more long-term, it's aimed for a longer average maturity of its debt stock, which, by the way, over time I think is a very sensible thing to do. It's a good policy. Obviously that's caused, and again, this is the responsibility of the Debt Management Office, that's caused some reassessment of just how to manage the debt issuance programme going forwards. That's sensibly pragmatic in my view. But I don't think there's anything particularly unusual about the UK in terms of the curve. What's a bit different about the UK is that the average maturity of our government debt stock, I think, is about double many of the other major countries. Obviously that means it has somewhat greater implications for management of our public debt.
Yeah, but still, the financing costs for companies, for households, they're much higher than elsewhere. I know it's because of higher inflation, but are you willing to sacrifice growth over the rates?
Well, there will be no sustained growth unless we have stable, low inflation. That's that's sort of almost written on the heart of all central banks, and it's very much, it's very much the key of our mandate. That's our objective. I'm not trying to, in any sense, crush growth. I don't want to, in any sense, give you that sense. Not at all. We want to see sustained growth. We want to see stable, sustained growth. That will require raising what I call the potential growth rate, the supply side growth rate. That's really very important. And this is absolutely key to all of this. But by the way, if you look at our cost of mortgage borrowing, that of course is priced really off the shorter end of the curve in the sort of the 5 to 7 year range. That hasn't actually moved in recent times much at all.
Yeah, the UK is special not only in that respect, but also in the respect of quantitative tightening. You do that differently than the others, but there's also growing criticism that you should actually do much less when it comes to the active selling. Are you willing to hear those critics?
Well, first of all, the reason that the UK we have a rather different approach to quantitative tightening is actually the point I was making a few minutes ago, that the UK has an average longer maturity of its debt stock. So if you go right back to 2009, when we started quantitative easing, we said that we would always, we would do the programs without, in a sense, having any distorting effect on the market. So we bought a balanced sort of mix of the debt, which means we've got a much longer debt stock in our portfolio. That means the natural runoff is not going to happen for a long time. So that's really why we're selling actively as opposed to just letting it run off. Now, we review this every year. We are literally and we always do it over the summer, literally we're about to start the review. And every year is a review, and we will review everything that's gone on. I've made the point a couple of times, happy to make it again, which is I don't believe that quantitative tightening is actually causing the steepening of the yield curve. But the fact that the yield curves have steepened is something that we will obviously look at in terms of the implications of that, the impact of it, and how we judge, the appropriate program for the year ahead.
What's the reason why you think the yield curve has steepened that much?
Well, I think it's probably partly it's a response to the high level of uncertainty in the world economy. I think it's also that there is greater certainly I look at our curve, there is much greater illiquidity at that end of the curve. So it tends to get affected, I think, rather more than the more liquid end of the curve. And I think that, like I say, looking at our market, that's, I think, certainly what we've seen. There's been a change in the liquidity of the curve at the long end, and that's affected yields.
Is it also that you think investors are concerned about the viability of the debt stock?
No, I don't. I don't think there's any question about the viability of the UK's debt stock at all. Actually, I don't see that. I think, and I think if that was the proposition, then I would expect to see far more effect in the sort of the benchmark part of the curve. But we're not seeing that. So no, I don't subscribe to that view.
Yeah. Let me bring you back to this upcoming meeting in September when you look at the QT plan ahead. Are you, or is there a willingness that you think about reducing the amount you sell actively?
Well, we go into every year's review
Yeah.
with all the options on the table, so I'm not going to speculate where we're going to come out, but what I will tell you is that is a live decision.
Okay, that's great. Thank you. Let's talk a bit about the outlook for the second half for the UK economy, because the UK economy seems to be also in a tricky situation despite having that trade deal already in place. So where are the headwinds?
Well, I think you can look at both internationally and domestically, and of course they do interact. Internationally, I think there is an increase in uncertainty. We've also, we love the sort of dictionary, so we've also introduced the word unpredictable, because that's where you can't really, you can't use history so easily to judge what's going to happen. I do think that's a feature of particularly the trade and tariff world. We're in uncharted territory, really. That increase in uncertainty and unpredictability is definitely coming through in terms of activity and growth. So, and I tell you, when I go around the country talking to businesses, which I do a lot, what they tell me is that they are putting off investment decisions. And of course that accords with what we know from sort of economics, which is these investment decisions, they're often one-off, they can't be reversed once they're taken. So, if you have the option to wait, when you face greater uncertainty, you'll tend to take that option, and that's what's happening, I think. We are seeing that. I get told it when I go around the country. So there is an international effect here. I think we've been very clear that I think the effect of this uncertainty is seen more on activity at the moment than on inflation. I'm not surprised by that, because the inflation effects could go either way, and they will take longer to come through. Domestically, to add to that investment uncertainty, I think what we've seen in the last a year or so is a higher saving rate, and therefore commensurately somewhat weaker household consumption. Up until at least the figures that came out yesterday, we'd had rising real household income for some time, a couple of years or so. But interestingly, it wasn't passing through into consumption in the way that the sort of history and therefore the models would tell us, which is another way of saying the saving rate was higher. I think, again, that's when we do a survey every 6 months or a year, asking people, what's behind those decisions. I think precaution, rebuilding the real value of savings after the inflation we had, obviously 2 or 3 years ago. Monetary policy is restrictive, so interest rates are higher, which of course makes saving more attractive. I think those things are featuring it. Now, of course, the big question for us is how long will that go on for? Now, we saw a bit of a dip in the saving rate in the figures published yesterday. One figure doesn't make a trend, as it were, so let's wait and see where that goes to. But that's an important judgment as well, I think, in terms of the outlook for growth.
But it's interesting, I think, that UK businesses do think that the uncertainty is super high, because clearly you have a trade deal already in place with the US administration, but that means that they look at the rest of the world as well.
They do, yes, they do. And I don't think we should be surprised at that, because the UK is a very open economy. Always has been. I think it's a very good feature of the UK economy. What that means, though, is that other people's trade deals are as influential as our trade deal in that sense. So they will be looking at what's going on in the rest of the world, and they will be studying it very carefully. So while I think it's obviously a good thing that the UK government's got a trade deal, and I know they're working very hard to get it implemented. What the rest of the world does is a sizable factor in judging the decisions made by UK companies, and therefore judging activity in the economy.
Yeah, how important is Europe?
Well, Europe's obviously important because it's our largest trading partner. So, yes, I mean, EU, US important, but so is China as well, of course, because China's obviously an important part of our trade as well.
Yeah. You have a new job as well.
As of today.
Yes,
because
as
I
of
don't
today.
have enough to do. That's
my question is, what's on your agenda? What do you look at the new head of the Financial Stability Board?
Look, there's a few things on my agenda. So let me start with the sort of medium term or the permanent bit, and then come back to the priorities. The permanent bit, I'm afraid, is to emphasise. I'm not afraid, actually. I have to say it. There isn't a trade-off between financial stability and growth. Financial stability will support growth. Now, I always say in the UK, does that mean every one of our rules is perfect? No, of course it doesn't. They're not, and therefore we work on them, we improve them, we'll do that. But at the root, financial stability supports growth. I'll give you 3 things that are very much on my mind in terms of priorities for our surveillance internationally and domestically. One is the much the much greater leverage in the non-bank sector, the huge change in intermediation in core markets, take government bond markets. Now, we've had some interesting tests of this in the last couple of few months, so we've got a lot to learn from that. What have we learned? What have we learned about resilience, fragility? The second one is I think we do need to lift the lid on the private equity, private credit world, not because I'm saying there's a sort of, there's a massive problem staring us in the face. It's too opaque at the moment. So understanding the lie of the lands, the vulnerabilities, the strengths. The third one is obviously the big shift now towards the potential growth of stable coins and what the implications. So, if you had to push me to list three, there they are.